All right, everyone. Good afternoon. My name is David Rose. I'm emceeing the Q&A session for today, and welcome to you all. So we've opened the entire session up to our panel of experts that have really been looking at their area of specialty. So we're covering landlords and tenants for commercial and residential. I've got loan specialists here. I've got the insolvency specialists here. I've got people who know the whole JobKeeper stimulus stuff from Cash Boost as well. I've got my people and culture head of people and culture here as well. So we are opening up for questions for any of these people. I'm going to MC and I'll direct the questions to the relevant people as I see them come through on the panel. So please feel free to type your questions in the panel. Obviously, a lot happening this week. I might just kick off with a few just general things. So, as late as yesterday afternoon, we have the eligible business participant nomination form that's completed by the tax office and available and ready. They've overcome the glitches in the processing of eligible business participants where there were no employees, so that's now all been fixed. So everything's well and truly working within the ATO system for processing. Obviously, being another big week just from a Queensland component with residential tenancies. I think a lot of people would have seen where we started last week and where we've ended up in terms of the legislation, which is a long way from where we were. We're seeing a lot of activity now from landlords and communications, with their clients, and for the benefit of a couple of groups of people. If you're on the Sunshine Coast and you operate a business on the Sunshine Coast, we're aware that the Sunshine Coast Council have sponsored an hour of time for business payers through their network. So you've got access to Vincent's are on a panel there, so we have access there for anyone who operates a business and their business has got a law firm that's got less than 5 or less practicing certificates. Queensland Law Society have been kind enough to provide you with access to effectively 3 hours of advice. We're also on the panel there. So if you've got any questions about those sorts of things, please let us know. But I'm going to kick off the session and just start working my way through the questions list and directing them to the relevant people. So question here for either Yo or Beck. Regarding the JobKeeper subsidy, is the payment available to business owners in circumstances where the structure is a partnership of trust? Who wants to take that one? I know the answer, but
you know the answer, Rosie.
Yep.
In terms of I think the way it's written, it's got to be an individual that's in partnership in order to access it. So that the partnership itself is the one that is the business. Therefore, it needs to be an individual partner. So in that instance, where you've got a partnership of trust, the way it's written, I believe that you do not meet the test in order to get access to JobKeeper in that instance.
Yep. So fundamentally designed for ABN holders who are carrying on, an enterprise and flowing down through to an individual.
Yep.
All right, I've got a commercial landlord tenants question here. So, John, for you, what is the situation for commercial landlords or tenants regarding outgoings if the commercial code is to apply, and this is yet legislated in Queensland?
Sure, Tracy, I'll answer the second part first. It's not legislated in Queensland yet. was debated in Parliament last night, and the expected date that it'll be legislated is the 28th of April. In relation to the first part of your question, look, the whole thing about the code is to have a proportionate sharing of cash flow between the tenant and the landlord. So in terms of outgoings, the specifics that it deals with in the principles is one that if the landlord gets any benefits, reduction in land tax or any benefits, it's supposed to pass those on to the tenant. And the other one is they should look at waiving outgoings completely in situations where tenants aren't trading at all. So they're the two key things that are specifically dealt with. In ones that we've been dealing with, the percentage turnover seems to be getting applied to outgoings as well as the rent.
Just on that, John, is the code that Queensland proposing identical to what the Commonwealth Government announced earlier in the month?
Queensland indicated that they will be legislating in consistent with the code, the mandated code.
Alrighty, thanks for that. So a question here regarding casual employees. So Beck, this might be one for you. I have a casual employee for 8 years. Gave us a letter in February saying that she needed 12 weeks off for an operation, so hasn't been paid since the beginning of February, but will be back in May. So do we claim the JobKeeper for her?
So providing, well, she meets the criteria of being a long-term casual. On 1 March, she was off in February. She hasn't resigned from her position, I'm going to presume, and on that basis, I would suggest that yes, she did. Did you have any objections to that, Yo?
No, I don't think so. I think what you said is correct.
I mean, I think it might be, providing that it was documented, her employment hadn't been terminated, I think that she would still be eligible, yes.
Yep, employee as at 1st of March, long-standing. They just need to make sure that they pay her.
Yes, correct.
Okay, so So from Stephen Robertson, another JobKeeper question on JobKeeper fortnights. If we paid staff $1,500 plus on the 1st of April for the 14 days up to then, and then again on the 15th of April, do we need to do any more to meet the minimum $1,500 test? The ATO guidelines seem to say that's enough, but we're hearing inconsistent things.
Yeah, he's correct by saying the ATO it meets the ATO guidelines. So technically, the payments have been received in the month of April. The technicality might be that the payment on the 1st of April relates to a prior period of pay. So I'll need to probably come back to you separately on that one just to check. But the way the ATO have written it, it's based on the actual payments themselves. And as long as you've made the 2 fortnightly payments for the month of April, you will get reimbursed for those in May.
Yep, I'm comfortable with that. You don't have to align your payroll periods with the ATO JobKeeper fortnights.
I agree. Yeah.
You're welcome, Tracy. Okay. I don't have Brett on, but it's an SMSF question to do with rentals. So what happens to rentals for a property that belongs to an SMSF? The rental revenue is high, say 75K. What if the landlord can't meet the commitments? Is the SMSF in breach if rents are not collected?
Do you want me to address that, David?
Yep. Are you comfortable in doing that one?
As best I can. Firstly, the the mandated code applies equally to super funds. If the question is in relation to the landlord cannot meet the commitments, I take it they mean their funding commitments. Not exactly sure.
Yeah, so there's SMSF rules, I'd imagine, that apply here.
Yeah, so the only thing that I know in relation to the SMF is if it's a related party, you can still apply the code, but you just need to document everything in relation to why you've reduced the rent and have justification for that reduction, just like if it was a third-party landlord.
Yep. Okay. We might whilst we're on, we might just Yo, do you want to just snap a photo of that and shoot it through to Brett and see what his response is?
Yep.
David, I've got a strange suspicion there's going to be some legislation which will effectively take out breaches during that period of time as well. So
yeah, well, it seems to be the norm at this point in time. Okay. Jamie, follow-up question regarding the JobKeeper. The trustees of each trust. The trustees of each trust are the individual partners. The trustees of each trust are the individual partners, so the payment would flow directly through to the individuals conducting the business who are experiencing a reduction in turnover and therefore personal earnings. I don't think it makes any difference who the trustees of the trust are, does it?
No, it refers to individuals. So it's either got to be an individual in partnership, and in the event that the trust is trading in its own right, it's an adult beneficiary of that trust. Yep.
If it helps you anything at all, Jamie, I've got 45 people in our practice that are a little bit sad about that process as well, including most of the people on this webinar. Ashok, this is extension from the question before on the super funds. The landlord's insurance policies. The landlord's insurance policies can be null and void if the rents are adjusted. What recourse is available?
I can address this one perhaps. Typically where you have the landlord insurance, it's in relation to residential rental arrangements. And the difficulty you have is whenever you bring into play different insurance companies, then the policies are going to vary considerably. But Ashok, you're right. If you elect to reduce the rent outside of the framework of the lease, then many of those insurance policies won't provide the protection. I would recommend in that situation to always liaise with your insurer first and sustain transparency there and inform them that you intend to follow the path that you do and seek some sort of consent in writing that you're doing things in a complying way. It'll be interesting to see to what degree insurers decide to protect. I suspect that there will be, it may be similar to what we had in the floods here in Brisbane, where a lot of people think that they're covered, but under these particular circumstances, they may not be.
All right, cool. Question in from Anthony. If our team has been on reduced salary by 15% through April, if the company is now on the JobKeeper program, is it legislated that you have to reimburse the 15%?
I'll chime in here. It's not legislated that you have to reimburse the 15%. However, I would qualify that with where the 15% reduction took the particular employee under the $1,500 a fortnight, then you would have to top them up.
Yep. So the other part is it's really I guess it's up to each business to decide how to use the proceeds. Obviously, no one really knows the impact on their business specifically of recovery and the time frames for recovery. So you've got to make the choice regarding your cash flow. Obviously, wages is only one component, of the cost of a business, and you need to look at things like, other costs that you may have deferred, that you're coming up for, meeting downstream as well. So so you've got to make the decision as a business owner how you use those funds. One of the things that I just thought I'd do, seeing as I've got got the benefit of some wisdom, the wisdom around the table, is just for people to talk a little bit about some of the things that they're seeing in here. I'm gonna jump out of my chair shortly and put Phil Ringway in from a lending perspective. But what I might say to people, what I'm seeing from the QRider, for those people that went for the state government $250,000 loan process, 27,000 applications. The applications are obviously now closed because they really only had capacity to take 2,000. The ones that I am seeing that are getting approved do not appear to be in either retail, hospitality, or professional services. They seem to be the ones that we're seeing on our end that are being approved seem to be more blue collar businesses. I do not know whether that's intentional or not. And the only other thing that I'm hearing is that they're looking at some other form of loans outside of QRider, just because of the the number of applications that they had there. So if you haven't heard, if you lodged an application regarding that and you haven't heard back from them, and you're in one of those other businesses, I'd be surprised if you do end up getting approved. One of the things obviously this week is the residential tenancy stuff. So Tim, do you want to just just give people some insight into where that landed?
Sure. There's been a lot of concern, a lot of tension with respect to the mandate there. It's obviously because it's state-based. There's been some jostling for who goes first and on what basis some of these changes are going to apply. And we saw quite what was perceived to be a tenant-biased narrative coming out from the state government that's been countered more recently. And some of the concerns that existed there were around the moratorium in evictions for 6 months. And in that situation, there was a concern from many of the landlords that individuals would look to abuse that and simply not pay their rent when they have the capacity to, or weren't impacted by COVID-19 restrictions or employment issues or business-related matters. So we've had clarification there from the government as they're continuing to work on these measures that haven't been finalised, that they have no intention of leaving that as an overall strategy, that if someone is under the existing rules, not impacted financially, and they've got a framework around the percentage of financial impact, or if they're a nuisance and being destructive of the property, all the sort of reasons why someone can be evicted ordinarily still exists. So I think that's put a lot of landlords' minds at ease. And there was some concern that the 6 months moratorium might be at the end of the period, such that it might add on 6 months if someone's lease was due to expire later in the year. But that's simply not the case. So state government's come out with reinforcing some points and clarification around the expected drops in revenue. So 25% reduction in people's income, and an expectation that where the show that the rent exceeds 30% of the tenant's income before they'll be deemed to be eligible for the the genuine distress situation. What I would alert people to is that there's also a grant for those that have tried to negotiate with their landlord, have lost their job, and are unable to get a response from their landlord that's favourable with respect to deferment or abatement of their rent. And that grant application process is due to expire on the 27th of April. So there's only...
So that's Monday next week for those people who haven't availed themselves.
So that grant is up to a maximum of $2,000, and it's calculated as 4 weeks worth of rent. And what you need to do is be able to prove that you've applied for Centrelink benefits, and that you can show documentation of your landlord also confirming that they won't offer you any relief, and that they have also been impacted by the COVID-19 arrangements to be able to submit that application. So I strongly recommend, if anyone is aware of or is on this this call, that they look at that promptly and submit their application if they're in that sort of state of distress.
Thanks, Tim. Whilst I've got you too, just the Queensland government's moved away from waiver and more on deferral now as well. That's correct?
That's right. Yeah, and really to assess things on the basis of each circumstance. It's difficult to put in place standard rules when so many people's circumstances fluctuate. And the idea that they had suggested that it's an opportunity for people to reset their rental rates has been debunked. It's really about supporting people through this difficult time, and not to be seen as an avenue to reset the rental rates. The reality is that we may or are likely to see that in the marketplace. If you start to look at some of the statistics of what's happening in the marketplace, with vacancy rates increasing considerably, you've got a lot of the Airbnb accommodation that's being taken off that short-term leasing or rental market and placed in the long-term pool. People that were looking to sell their houses that are no longer wanting to sell their houses in the current environment because of the restrictions there, are placing their properties in the long-term pool. So we've seen a rapid escalation in the vacancy. So while the government is indicating that they don't want to see that rent base reduced by virtue of the framework they put in place, the natural dynamics of the market will dictate that between demand and supply.
Okay. Thanks, Tim. John, I just got a question for you. Question that come through regarding how do you assess the mandatory code of conduct 50-50, so 50 waiver, 50% deferral against any other option? Like I've got a situation here where the landlords come back and said we'll do a 75% waiver, but start paying or continue to pay 25% now. Obviously there's a cash flow component to it, but how do you weigh up, in your mind, how do you weigh up what the best option is in those sort of situations where they want to move away from the mandatory code of conduct?
Well, the mandatory code of conduct, which is really, the whole thing about it is just good faith negotiation. Once it goes through Queensland Parliament, it won't be able to be waived. That'll be the law. And under the code that the federal government put out, it deals with situations where at least 50% of the reduction needs to be, a minimum of 50% needs to be the waiver. So that's, I suppose, a guide right now. I'm not exactly sure what's going to happen. I know there's a lot of deals have already been done. And I take it if deeds have been signed varying the leases, then they'll be a binding contract. But there is some concern about people entering into agreements that are then going to be contrary to the law once passed by state government.
And but would you do some sort of net present value calculation on those? Like, do you just take both options and then work out, what the value is, just assuming everything else that they're going to be okay to pay downstream and all of that sort of stuff, to really just to weigh out what the better option is?
Yeah, look, ultimately, even the code's clear that it's all about trying to make sure that the tenant and the landlord can both survive coming out the other end of this. So, from the tenant's point of view, they've got to consider what's best for them. If they're confident coming out the other end that they've had an immediate effect now, then but they've got no cash flow at all, then they obviously want as much waived as they could. Similarly, if they think, well, we're not going too bad, we've got something, if we can get a bigger amount of money and have it for deferred, a bigger reduction and have it deferred over a long period of time, then that's going to be the best result to us. But you're right, from a mathematical point of view, you could do a net present value calculation to compare those two alternatives.
Okay. Keep bringing your questions through.
You missed one, David.
Yep, there's two that's just come through now.
Yep.
So when should our organisation apply for JobKeeper if the organisation's using projected turnover for May? Yep,
so I'll chime in. The JobKeeper enrolment is actually open until the end of May. You could go in and enrol. There is an actual drop-down menu when you go in to register that asks you to select which month you expect your fall in turnover to happen. So I suspect that will get picked up then. So if you did want to go in earlier, I'm sure that you could. It would just mean that you're not eligible until when you actually demonstrate that fall in turnover. But just to clarify, the JobKeeper enrolment is open. They've extended it till the end of May.
And is that extended till the end of May for picking up payments that have been made in April?
That's my understanding, yes. Is that yours, Yo?
Oh, we didn't hear you, Yo.
He's dropped out. Nod your head, Yo, or say no.
Yes.
Thank you.
Awesome. So a question here from Graham. Do Vincent's have any fact sheets or guides about business recovery plans, or is there anything you can recommend for guidance? So Graham, we've got we've got a number of forecast spreadsheets that we're working with clients that are sitting on our website that you can download. We're happy to assist you with those, but it's particularly in relation to situations where people have been deferring things like deferring loans, deferring tax, deferring rent, deferring utilities. The whole the 9 yards, so that people can understand. Also, I've done some significant amount of work with my hospitality clients in the anticipation that when they do reopen, that they'll be having to implement social distancing within their venues. So we've got the information from them regarding how many people they know that they'll be allowed to have in their venue at any one point in time from a social distancing perspective, and then working the forecast from there. I think that it's there's a lot of the feedback in some respects is that there's people that who have jobs that are saving money that are the money's burning a hole in their pocket and they can't wait to get back out there. You've seen the news about Australia Post and the delivery around the delayed delivery on parcel services because of all the stuff that people have been ordering online. But I think it would be wise for people who are looking at the other side of this to be cautious in relation to what their projections are for their business. But Graham, please reach out to us. We've also got our turnaround recovery guys. So Nick, you guys do that sort of work as well?
Yes, absolutely.
Okay, question from one of our directors. I understand that the cash flow boost is not taxable. That's correct, Anita. If it's received by a not-for-profit that receives funding from government sources and therefore has to evidence acquittal of that funding within a certain time frame, does the cash flow boost have to be acquitted in the same manner? I have no idea, Yo. What do you think?
I'd have to think you'd have to go back to the funder, being the government first, just to see whether there's a variation on that, on the amount of funding that's provided, to the tune that you've received the cash flow boost.
Yeah, because it is a grant.
Yeah.
It is a grant. So it's whether the grant actually gets reduced by way of a variation for the cash flow boost that's been received.
Mm.
We've got a question. We've had many of this conversation with our client Stephen regarding your next question. Any insight on what the payback obligations and penalties might be if you estimate your turnover drop incorrectly? Yo, Beck, do you want to deal with
I'll leave
that
that
one?
one with you, Beck.
Oh, look, the grey area, we love it. The commissioner has expressed he is going to have some discretion in this area. So I think without it's not specifically legislated. There's no hard and fast rule in relation to it. However, I think if you could demonstrate that it was reasonable. And that you weren't hugely disparate to the 30% drop. There is some literature out there, Stephen, that suggests that they will have discretion to continue to pay it. So no payback in that instance. However, if you significantly are out, payback is required. I'm not sure on the penalties in relation to that. Yo, did you have anything to add on penalties if you were significantly?
The penalties are massive.
They're significant, so it's something that you don't want to be playing with in terms of assessing the turnover test. Admittedly, if you get it wrong and you've done everything in your powers to assess what the turnover looks like in the future and what the actuals are, and there's been no sort of smoke and mirrors in that respect. I think the payback provisions probably will only apply to those that have grossly misled their eligibility in order of accessing the scheme.
So it's GIC. So, just some specifics, Stephen, I guess it's GIC and sort of the circumstances where it's a close call and not manipulated. If you start going past the manipulated part, they can do jail terms. They've got penalties equating to 75% of the amount that has been overpaid by way of penalty as well.
Actually, you're right. There was some criminal charges potentially, involved too. So, err on the side of caution.
Absolutely, and just it's probably a good time just to check in with people, just to say to make sure that you actually document your turnover test calculation. So obviously with the basic test, there's ways of doing it. We've put something on our website for you that looks something like this. I'll just share my screen. So there's a spreadsheet. There's a spreadsheet there where you can you can select the month that you're looking at, and type it in there, and it's something just to keep on your file, to be used there as well. Again, it's available if you go into the hub section of our website. That spreadsheet's available there for you to use. Okay, getting back to the questions. The commissioner will decide later, and there may be big penalties. Awesome, that's correct, mate. Sorry. Question here from Tracy: if you're using the quarterly turnover test as cash flow, does have some monthly variability. However, do qualify across the whole quarter. What happens when a month is not down by 30%? but the next is well down. Ultimately, the quarter is down 30% or more. We had many a debate about this internally. Yo, I'll leave that one to you.
All right. So essentially, the turnover test is you can choose between, I guess, monthly or quarterly. So in terms of being eligible for the first fortnightly period, being the 30th of March onwards, you can use what your projected GST turnover is for the quarter ended 30 June 2020. Right. So on that basis, if you believe that your quarter for the ended 30 June 2020 in comparison to the quarter 30 June 2019 was 30% down, then you can register and gain access to the JobKeeper program from the 30th of March.
Mm.
All right, so I'm just going to add on to a question there, Yo. That means that you don't necessarily have to be registered for GST on a quarterly basis in order to make that quarterly assessment?
Correct, it's irrelevant.
We talked a bit about that internally. Keep your questions coming through. Nick, I might just pass over to you. Obviously, it's obviously been a big week in the world of administration and insolvency with the announcement that Virgin has gone into administration. So, do you want to maybe just just talk briefly about some of the things that you're seeing from your side of things regarding the moratoriums and that and stuff around insolvent trading?
Yeah, absolutely. So in order to forestall a lot of corporate and personal insolvencies, the government's come out with some legislation which has got a 6-month applicability from the 26th of March. So what they've done is, in order for a creditor to enforce against a company or an individual, there needs to be a minimum debt of $20,000. Previously, it was 2 for a company and 5,000 for an individual. Now it's $20,000. Once you get served with either a formal statutory demand or a bankruptcy notice, you have, instead of the normal 21 days to comply, you now have 6 months. So what the government has basically done is bought a lot of businesses a lot of time in order to not be harassed by creditors, in order to make proper assessments with their advisors about what they should do, depending on how long the COVID shutdown occurs and what happens coming out the other end. Plus, of course, whatever other government funding or other schemes might be applicable to that specific business. In addition to that, insolvent trading has always been a significant risk for many corporate directors. So insolvent trading is effectively a director being held personally liable for debts incurred by a company at a time when the director should have known or suspected the company was insolvent and would be unable to pay those debts it incurred. Very similar to what effectively Safe Harbour provides. So people would have heard of that whole Safe Harbour legislation. In effect, what the government's done is basically said for 6 months, we're going to give every director the protection of Safe Harbour, but we're not going to call it Safe Harbour, we're just going to call it protections under the law they introduced, on the basis that the director acts honestly and appropriately. So you won't get that protection if you still intentionally rack up liabilities and you have no belief you'd ever be able to repay that, or you have no intention of opening up at a later stage, but you're still incurring debts nevertheless. Now, when we talk about incurring debts, if you've got an existing lease, you're not incurring a new debt. It's a debt that was incurred when the lease was signed. So don't be concerned about lease obligations or rental obligations. It's basically going to a supplier today, putting in a new order today. That is a whole new arrangement. Whereas all those finance and leasing obligations are all pre-existing, so they're not going to be applicable under this. So what has happened is through the JobKeeper, it's a really interesting piece of legislation, because what the legislation effectively says is if a company goes into liquidation or an individual goes bankrupt, not able to access JobKeeper, However, companies that go into voluntary administration, vis-a-vis Virgin, companies that might go into receivership, or perhaps an individual does a Part 10, then the JobKeeper subsidies would still be available. So what is likely going to happen and will continue to happen is you'll see these larger organisations and the smaller ones as well take the opportunity to restructure their affairs, perhaps say in the case of Virgin, maybe be a slightly smaller, less overhead type run business. They'll do that through a voluntary administration and a deed of company arrangement process, whilst in the meantime still getting all that money to pay their employees to keep them on the book. So when we come out the other side, and we all will come out the other side, and let's all not fear that it won't happen, it will happen, they will then be primed to take off, so to speak, in many ways.
So they're the sorts of conversations that you're having with people. And just whilst I'm doing that, Nick, can I just test with our audience? I just had a message that we've lost the voice. So if people can just answer yes, we can hear you, that'll be great for us. Otherwise, we think we're talking to ourselves.
No. Can you guys all hear me?
Yes.
Yeah.
Well, okay. Well, I'll keep going, Rosie. So,
yep.
So a lot of conversations are being had about businesses that maybe were a little bit on the edge before COVID, and this has kind of pushed them over the edge, or others are saying, well, you know, I've had a restaurant, I've been closed for 3, 4, 5 months. This might give me an opportunity to sort of restructure, come out the other side, continue to operate, but perhaps in a slightly modified, different form. So there's lots of those conversations going on. There's lots of opportunities to do that. And I think the beauty is we've got some understanding from financial institutions and banks. You know, they've deferred interest for a long time, but I think we all need to be careful with the banks. They've not actually given up any interest. They've not given up any security. What they've effectively said is, we'll give you a 6-month holiday, but after 6 months, then that interest will, and over that 6-month period, continues to accrue and will only basically hit your account then, and they'll either amortize it over the duration of your loan or over a couple of years or whatever you may or may not be able to negotiate. So people need to be very mindful that the bank's not going away, their security is not going away. So we just need to understand the whole picture. If there is opportunities for restructure, that, you know, you have the very difficult sometimes, but very important conversations with your accountant, with an expert advisor who understands and can put in place a plan of attack. And I think the opportunity over the next few months to do a lot of restructuring, whether it's formal through an appointment like a voluntary administrator, or even informal. If there's only 2 or 3 parties you need to deal with, then you just need to have that ability to negotiate with those. So some corporate advisory type services, which I know our firm also offers, I think those are great opportunities for people to take advantage of.
So Nick, I'm going to put you on the spot. Why now and not in 6 months' time after the moratorium? I know that you've just talked about the restructuring piece, but what's really, you know, I mean, you know, Virgin may lead the way with some of these sorts of things with administrators as opposed to appointing liquidators. But what would you say to someone? Why now?
Well, there's probably a couple of factors. One, if you believe the chatter about the curve and the flattening, and talk about the gradual lifting of some of the restrictions we're under now happening over the next few weeks, I think it would become harder once things start to, inverted commas, open up a bit more. There's more ability for people to say, well, what you're saying is not right because you can trade or you can operate, or there's no, the restrictions on you are far less. I think that's one reason. Another reason is I think those who get in first and get in earlier generally get the better deals as well. I've always been a great believer on that. I've been a great believer in being very proactive. The other thing too is that a formal appointment and a deed of company arrangement still is from go to the signing of the deed could easily be on a relatively quick moving one, 7 to 8 weeks. You'll see Virgin will probably be more to 3 to 4 months, one would suspect. So you've also got that time lag as well. So I think it's really important, like I said, every business, every entity, every SME is going to have a different structure, a different client base, a different creditor base, a different finance base. And I think you need to discuss, and there'll be horses for courses. Some, the advice will be don't do anything formal, but let's try to negotiate privately. Others will be, we think we should do it now for these reasons. Others, you'll say, let's delay it because we think that there'll be benefits down the track in doing this, this, and this. And, and unfortunately, there will be others which will basically say to you, irrespective, I'm not coming out the other side. And, maybe a formal insolvency now will be the way to go. One, because it's going to be down to what has just happened, which I think is helpful for some people. And the other thing is it'll take a lot of that stress, that burden, that worry off people's shoulders. And then they'll be able to basically draw a line in the sand and be able to move forward and things get better with a completely clean slate. So there are benefits either way.
David, can I just, Ashok asked a question before about the self-managed super fund. I've just got an answer for him from Brett Griffiths, who's our self-managed superannuation expert. So Ashok, effectively, if the tenant doesn't pay the super fund, which means the super fund's unable to meet its commitments, if it's with a bank, it'll obviously go into some commercial arrangement with the bank trying to defer the payment. If it's not with a bank, if it's with a related party lender, same deal could happen. You can enter into a commercial arrangement of deferral as a result of COVID-19. If it's a related party, it just needs to be documented, and it needs to be no more than what an arm's length transaction would have happened with a third party bank. And also apparently on our COVID hub, there's some checklists. So specifically dealing with SMS issues, including the one if an SMF fund who's got debt has trouble meeting their commitments. But Brett's of the opinion that as long as you do it as a independent commercial transaction, that the ATO will not take compliance activity against the self-managed super fund.
All right, Ashok's just asked another question, John, whilst you're answering that, and it's along the, and I'm not sure whether we can answer or not, but it says, should the rental be deferred instead of a waiver?
I think the answer to that question really shouldn't vary. It shouldn't have any bearance on whether the property is owned by a super fund or owned by an individual or a company or whatever. If it goes back to the code, and under the code, as long as you've got the 30% fall in turnover, up to 50% of the reduction is mandated to be a waiver.
Yep. Okay.
David,
Awesome.
I just have something that I see has come up. One of the issues that we're hearing about from clients and people out there with the JobKeeper is this concept of the one in, all in, particularly where you've got businesses that had a lot of employees and very tight cash reserves. And the practical principle of how are these businesses without a lot of cash flow or liquidity able to continue to maintain payment of the $1,500 a fortnight to a vast array of employees if they don't have the funding and they've got to pay that in advance of receiving the ATO money. And the government stance has been that they should just seek funding. But what we've been seeing is that the banks haven't been forthcoming with providing that funding. So there's some pressure that's right there. There's just been an announcement that a hotline is being set up, and Josh Frydenberg's been in discussions with all major banks that they're coordinating a response to bridging finance for supporting that that sort of funding.
Oh, that's cool. Well, they might miss it for the first 2 JobKeeper fortnights, but obviously, obviously some of this response is based on what they're seeing in terms of numbers of people that are accessing JobKeeper. I see, their announcement to extend the application through to the 30th of May for the first month. Is all of those sort of signs may indicate that not enough people are accessing it.
While we're on JobKeeper, David, the ATO have just issued their hot off the press. They've just issued a legislative instrument on the alternate test. So obviously we haven't had the chance to read it, but it's just been documented. So
nice.
It's out. Hopefully that will help with some of our questions around those alternate grey scenarios.
So do you want to just talk about what that generally alternate test was to start with, Beck? Yeah,
of course. Cover off on the basic test first. The basic test implies that you've got a projected turnover that's going to have a decline of at least the 30%, assuming that we're a small business, not over $1 billion, with a comparable period last year. So, for example, that could look something like April. My projected turnover for April 2020 is going to be 30% more than my April 2019, and that's GST turnover. So, where there's circumstances that basic test can't apply to you because there's no comparable period or because there's another reason in relation to that, then the alternate test may apply. So an example of an alternate test may be where your business hadn't started in April last year. It actually started in July 19. So if we use April now, we don't have a comparable period to compare to. So that's when the ATO can step in and provide you with an alternate test. And that might look something like, let's have a look at your average monthly turnover on every BAS, and if your April is 30% declined compared to that average figure, yep, you're in. Each time it accommodates. Another example is if you were impacted by drought, obviously, or floods or some kind of natural disaster like that. That could be another example. So that's what the alternate test is. It is the grey area, but there's now some more guidance on that. So that will help us around those tricky ones.
Yeah, I think the guidance. Just seen Kim's just messaged me saying that the guidance around the alternative test is for the business. New businesses commenced and business acquisitions.
Yes.
So
yeah, it also covers restructures, businesses that have had substantial increase in turnover, and businesses with irregular turnover. Also covers sole traders or small partnerships with sickness, injury, or leave.
Yeah, can you flick that? Can you flick that around so we can all absorb it? Got a question here. I think it's regarding labour hire entities. So if we hire full-time employees through outsourcing company, let's say we pay monthly $3,000 to the outsourcing company, and they pay whatever to their people overseas, which we have been using their service since September 2019. Are we qualified for JobKeeper? Our revenue dropped by 30%. Which one of you two want to take that one? It's relatively easy.
Essentially, it's only you only get JobKeeper in respect to eligible employees. So under this arrangement, they would not be eligible employees because they're actually employees of the outsourcing company.
Awesome. Another question here regarding, do we have any information? Oh, sorry, Graham, just for your benefit too. We've put a recovery toolkit in there for you to download in the chat. Question, do you have any information regarding GST deferral on imports?
Not at the moment, but I'll circle back, maybe go on to the next question. I'll find something on that.
All right. I'm not sure, whether that just I'm not sure whether that just falls into the GST net in any case, and that's speak to the tax office. Obviously, it was offset by the cash boost. We might just talk about that that new clarification that came out yesterday regarding existing tax debts and the cash boost as well, where they're not actually holding back any amount that was outstanding prior to the March BAS. Do you want to take that, Yo?
Yeah, so sorry about that. I'm coughing away here. Yeah, so in terms of the cash flow boost, initially we had thought, based on the way, I guess, the legislation was released, that any resulting credit once applying the cash flow boost would offset all other ATO liabilities before getting released to the business entity itself. It's now been adjusted that the cash flow boost only gets offset against the current BAS that's being lodged that is applicable to the cash flow boost, and any resulting refund after applying the cash flow boost against the BAS liability will then be refunded to the business.
So that's good. That's good news.
Yeah.
Ash Ox having a crack at another question. Can companies or trusts who lodge their BAS on a 3-month basis, can they get relief on PAYG or 5A payments?
So that's the PAYG instalments?
So PAYG is the first one, 5A is the income tax instalments.
So PAYG withholding, I assume that the reference is there?
Yep.
So in relation to relief, I'm assuming that we're talking about the relief may come in the form of a deferral of payment. So currently, if you have a tax liability that's arising after the 23rd of January, there is some scope to defer the payment of that till the 14th of September. That's on a case-by-case basis. It's not a global application, so you actually need to apply to the tax office in that regard. In relation to the quarterly PAYG instalments, there is current measures in place whereby companies, instalments wouldn't apply to trust, but companies can vary their March PAYG instalment, and in addition to varying, they can claw back their December and September instalments that have been paid. So that's a cash flow measure designed to help get some cash back into the company. Keeping in mind, though, that is a deferral also mechanism. So if there is an overall tax liability for the 2020 tax year, that will be due when the company's ordinary tax return is due to be lodged. So,
all right, and just with the PAYG withholding, obviously they have the cash boost acceleration for that first quarter, and that'll get offset against there anyway.
Correct.
All right, we've got a little bit of time left. So what I thought I might do, because I've had Gemma sitting there all nice and quiet, and she's not normally all nice and quiet. So we're seeing some absolutely atrocious behaviour from both employees and employers out there. Gemma, do you want to sort of just sum up a couple of things, and then I'm going to put Phil Ringway, our lending specialist, in my hot seat as well, and he can talk a little bit about what he's seeing from a lending trend perspective and what the banks have been up to. So Gemma, do you want to lead that, and then I'm just going to pop Phil on.
So I think first and foremost, I've been dealing with a lot of different clients, obviously of Vincent, so through some of the employment navigation. First and foremost, there's been a lot of work around consultation and agreement with employees to either reduce hours, reduce salary, and moving to a minimum salary so that they can effectively get JobKeeper with no top up. The other thing that I'm also seeing a lot of is altering of duties. So this has come up quite a bit with businesses who are effectively adapting and going into potentially other areas. Example I can give you is an adventure business. Obviously at the moment in terms of tourism, couldn't have any business day to day that they were running. So they set up a cafe and effectively spoke with their staff who they were paying JobKeeper to work within the cafe. There has been some significant changes during the next sort of 6 months made to the award, a number of awards, and the Fair Work Act to effectively allow for altering of duties in particular in a reasonable way. So when you are thinking about that, we've seen a lot of employees push back and say, I just want to take the JobKeeper, I just want to sit home. There is an obligation for them when they are given a reasonable direction to effectively respond to that and come to work and work the hours they would have been working, even if it is a slightly different business that they're now doing. The other thing that I've worked a lot with businesses on is forcing individuals and employees to take leave. And again, we've seen quite a shift in terms of the Fair Work Act and a number of awards around the minimum amount of leave someone has to have in the bank to be able to effectively force them. Most awards have effectively moved from 8+ weeks all the way back to 2 weeks now. So if you do have employees that you know are not going to be able to be working or not be as productive as they were before, and you want to look at reducing that leave liability, you do have that option far more available now than you ever did under the Fair Work Act and under a number of the awards. Likewise, I have worked with a lot of our clients around redundancies and terminations of employment. There are quite vastly different rules for small businesses of 15 employees and under in relation to redundancy. There are a couple of industries which fall outside of it, one of those being building and construction because they have a very particular award. But for the vast majority of awards, for those small businesses that do have employees of 15 and under, they don't have an obligation to pay redundancy. So a lot of clients that I've worked with who unfortunately have made that call to go ahead and wrap up their business and they have had to terminate employees have been very unaware that they haven't had an obligation around redundancy. So that's something you should definitely look at on an individual basis. The other thing I suppose that I'm working a lot with businesses on is just the more human side, I suppose, to all of this, and managing employees' mental health, managing workplace health and safety obligations. So because we have now moved to a lot of employees working in a remote working environment at home, there are obligations that you still have around the fact that their homes have now become their workplace. And so we are seeing some sort of work cover claims coming through which relate to accidents or injury that's occurring at home, because now it is effectively a workplace. So that's something that I'm certainly looking at quite a bit and seeing happening. Likewise, giving a lot of advice around ensuring that you remain connected to your workforce and remain and do all you can to keep productivity in place while they're working in a remote environment and morale up as we obviously come through this and hopefully out this at the other end. I think that's it for me. I don't think I've got any questions there in the chat. So over to you, Phil.
Fantastic. Thanks a lot there, Gemma. All right. Just have a chat on all things lending and perhaps banks as well. It's certainly been a very interesting environment. And Nick's touched on a couple of things that have taken place and also probably provided me a couple of good segues as well to discuss. Look, most of our clients have approached us in one way or another to talk about what their obligations are if they are borrowers, both to their banks, how do they access money, whether it's for working capital purposes, restructuring their business, or perhaps even take up additional opportunities. I think the first thing we say is one where we take a lot of caution. This is an environment to be really understanding exactly what your position is. Both today and importantly into the future as well. So whilst there are some really great and accessible opportunities as well, the first couple of things we do ask our clients to do is really just take stock of their position, understand their cash flows, and try to eliminate any unnecessary expenditure as well that might be in their current business or operation as well, because where there may be opportunities to basically continue to run through this period without having to actually use debt as a tool as well. So that's probably your first step there as well. The second thing as well is to restructure or renegotiate what you actually have in place at the same time. So whilst banks are very quickly offering deferrals of loan repayments, we've seen a lot of clients actually take those up very, very quickly, and they are a good opportunity as well. But what they haven't considered first is to perhaps ask the bank for a much cheaper rate, to take advantage of the current fixed rate environment, or to even restructure their current lending. So what they're effectively doing is they're deferring their loan repayments at a high interest rate that wasn't even in line with the market expectations in the first place. So it's really having that conversation first. Okay, so look, what are your steps if you are a current borrower? The first one is probably to look at deferring your existing repayments. So Nick touched on this really briefly, but essentially that's just asking the bank for a holiday. Now this applies to individual borrowers, so in your personal right, if you were even a PAYG employee, and it certainly does apply to business borrowings as well for SMEs. Which are defined as small to medium enterprises who have turnover of less than $50 million and an aggregated borrowing of less than $10 million as well. So if you are in that position, you should be able to go to your bank very quickly and ask them to defer your repayments for a 6-month period. So again, that's just a holiday. You still are actually paying interest on those repayments, and it may increase your repayments and your loan term post that 6-month period. You should be able to achieve that on commercial lending, residential home loans, whether they're for investment or owner-occupied purposes. You can also ask them to do that on commercial credit cards and also merchant terminals as well. Most banks are also waiving a lot of fees and charges that might be associated with loan products at the same time. So it's certainly worth asking them to do this as well. The secondary option, or the most favourable option, was probably for those who are based in Queensland, the loan scheme that was provided by the state government, or QRider. Now that's largely expired. I think it actually has been closed off. So for those who have actually applied for that, hang in there. We know there are long delays with that as well, and they may be potentially favouring certain industries or segments, but that probably is by far the most favourable loan option in the marketplace. The third one is the federal government guaranteed loan. So this is actually being provided through the banking network. So the federal government has effectively guaranteed 50% of the loan value, and they've also asked the bank to remove some of their actual there's responsible lending requirements as well. So where businesses have been caught up in the last couple of years having to jump through hoops, they've effectively eliminated a lot of those, and they've brought in some streamlined assessment processes at the same time. So what we're generally seeing in this space is businesses can apply for a limit of up to $250,000. And just to be really clear, that's for working capital purposes only. So that's for paying your rent, your operational expenses, your staff wages, things like that. So for the day-to-day operation of the businesses, it's not going to be afforded to you to restructure your current debt obligations or for capital expenditure as well. It's not that type of facility. The facilities are accessible. The recommendation is probably to approach your existing bank. We are supporting a lot of our clients with those applications as well, because it's critical that you actually get that story right. So it's one thing to go and approach your bank, but it's also another thing to be able to talk through exactly how you've been impacted in a way that the bank understands, and then we'll be able to convert that into credit for you as well. So, very important to have a great conversation with your existing advisor about how you might be able to access those facilities at the same time. Yeah. And there are, so David's just mentioned as well, so there are some catches to these facilities as well. So it is actually a 3-year loan payment with your first 6 months being deferred as well. They are being provided in the form of effectively an unsecured overdraft at a very cheap price point. So we're seeing them at about 4.5%. And relative to an unsecured overdraft in a normal environment, we'd be seeing them 6 to 8% plus in many circumstances as well. So keep in mind that does convert to principal and interest, and you are paying that over a 2.5 year period. So again, are you kicking the can down the road, or is it providing the right option for you at the same time? The third thing that we really are seeing is clients who are actually approaching the bank. So lending is still available as well. So where you don't need to defer your loan, or you don't need to take up those working capital schemes, there are actually opportunities in the marketplace, and we certainly are lending as well. A lot of our clients are restructuring their existing lending arrangements. They're pushing their terms out from the standard 5 and 10 commercial loan terms to 15 to 25 years in some circumstances. Banks are very happily affording interest-only terms in this period of time. So where you might have had principal and interest, converting to interest-only can certainly reduce the cash flow impulse on your business as well. And then from a pricing point, rates have also never been cheaper. Just to give you an example of that, from a residential standpoint, we're seeing lending as low as 2.09%, which is just incredible. A lot of our clients are starting to reach out now to make use of the instant asset write-off. So we're providing a lot of funding for that when it comes to motor vehicles or business equipment as well. So important to have conversations about how you access that. From a pricing point, again, credit really hasn't been cheaper as well.
Bill, can I just interrupt for a quick second? You got a question
sure.
about whether all these delays will affect your credit rating.
Really good question. So if you're deferring your loan, it's not a credit process. Okay, so there's absolutely zero impulse on your credit file as well. Now, we've been guiding a lot of clients through these applications at the same time, and the banks are just, they're just blown up. There's too much inquiry. They are taking too long, and they're the first to put their hands up that they are letting us down to an extent. So what they're actually saying is, for clients who are applying for that, if you do have a repayment that is actually due before they contact you and you don't have the money to pay that, you can actually just let that go, and they'll correct it when they actually talk to you as well. So just read through the fine print. Most banks are actually promoting that on their website as well, and they are addressing it in the best way that they know how. For the other loan applications, they are actually going to appear on your credit file as well. And there is a bit of a process. If you've applied for the QRISE scheme, which is the Queensland government scheme, don't go and apply for the bank scheme, because the first question they're going to ask you is, have you applied for that, and what was the outcome as well? So you actually need to find out, because you're basically not going to be able to get access to both in many circumstances. It'll either be a bank debt, or it'll either be a government-initiated scheme as well. But yes, those will have an impact on your credit profile as well. All right, I'll hand back over to David.
Just checking if there's any other. Will there be a recording of this webinar? We are recording it. What's your advice to business owners on financing the JobKeeper payments, particularly those businesses who can't afford it right now? We're obviously, the big banks have just announced the whole bridging finance thing, Alex. So, the rules do require it to pay. We are aware and seeing clients that are just processing the payroll and just shooting it through single touch payroll without actually making the payments. We think that they're leaving themselves, open in that regard, given that the payment is required. I've seen a lot of people adopt the strategy that they'll make the payment on Monday for the entire month of April, so that they've narrowed the gap between the time that it's being paid and when they get it back. One of the calculations I did the other day, Tim mentioned before the rental assistance in Queensland, but one of the calculations I did the other day was comparing the net amount that you receive from the JobKeeper if you're on a fortnightly basis. So net of tax, that amount is $1,302. When you take into account the job seeker, $550 a week, so that's $1,100 a month, plus $1,100 a fortnight, plus the fortnightly amount for the rental assistance of $153, plus the two lots of the $750 payments that you get for job seeker, that actually totals $1,368. So you're comparing $1,368 effectively on a fortnight for job seeker versus the net $1,302 payments for job for JobKeeper. Obviously, if you remember, all of this JobKeeper stuff was really just designed for us to be a Centrelink, intermediary for people and trying to keep people in their jobs along the way. So, we're aware that there are a lot of people that, that can't fund it. And that's unfortunate. The bridging thing, I'm whilst optimistic, probably skeptical about how quickly the banks can pull that together, given Phil's previous comments, regarding the amount of time that it's taken to do things. We've seen the bank's response in relation to deferrals of loans taking taking the month, in order to get back to people. So approving them for finances, bridging finance, it's going to be interesting. Obviously, we've got, it's a marathon, not a sprint. We've still got a long way to go in all of this. So it's a lot to fathom as businesses go. One more question that's just come in regarding subcontractors who are PSI individuals and JobKeeper entitlements. Beck or Yo, do you want to deal with that?
I guess I'll take it. So essentially, you need to look at the entity that's supplying or that's in business, that whether its turnover would drop, and then if they're an eligible business participant, then they would apply under that avenue. So in the instance of a company, it would need to be a director, individual director, or an individual shareholder, and only one would be able to access the JobKeeper payments. In the event that it's a trust where there's some PSI, it needs to be an adult beneficiary, and if it's a partnership, it needs to be an individual partner. You got anything to add, Beck?
No, I agree, Yo.
They're not employees in your sense, so they need to go back through their own. They need to go back through their own businesses fundamentally.
Correct.
If there aren't any other questions, I'll close up in a second. So we'll just keep an eye out for a minute for any other questions. I want to use the opportunity to thank the panelists for giving up their lunch break in order to answer the questions. A lot of people around this panel group have been working 13, 14-hour days in terms of assisting people. Obviously, this week's been massive with, the processing of the JobKeeper things. It's relatively simple for those of you who haven't done it. Takes less than 10 minutes, to do online in order to trigger it. Obviously, there'll be some monthly reporting requirements that come for that, and obviously, things will continue to change as the need arises. We will host as part of our investment in our clients and obviously the business community generally with a lot of the other initiatives that we do. We'll continue to host these Q&A sessions just to make sure that we're supporting both our clients and the business community generally. So I really want to take the opportunity to thank everyone on the panel. Thank you everyone who is online. Hopefully it's been informative and the ongoing education as we all learn as part of this. So stay safe, continue the hard yards. It's a marathon, not a sprint. And from a Vincent's perspective, as it says on the slide there, manage, mitigate, and move forward, and move forward positively as well. I was excited to see a bunch of our staff in and around the office today, coming in to get their flu shots. I've never seen people more excited about getting their flu vaccinations this year. So thank you everyone. Chat soon. Stay safe.
Bye.
Thanks. Bye.
Stay safe.
Bye.